If you are a scalper or a day trader, you definitely must try out these strategies. The failed new high or low of the day is the first scalping setup that takes advantage of price action and market structure. This strategy aims to catch quick moves when price fails to sustain a break above the previous day's high or below the previous day's low. So the core idea is to look for price attempts to make new highs or lows compared to the previous trading day. When these attempts fail, it often signals a potential reversal, creating a scalping opportunity. You see, previous day highs and lows are important levels, watched by many big traders. These levels often act as significant support and resistance. When price approaches these levels, it's testing the balance of supply and demand. When price breaks above the previous day's high, it implies demand is overcoming supply. If this break quickly fails, it shows that supply is still strong at these levels. The opposite is true for breaks below the previous day's low. This failure often traps traders who entered on the break. As these traders exit their positions, it adds fuel to the reversal move. This is how to trade this setup. First, identify the previous day's high and low. These are your key reference points. Then watch price action as it approaches these levels. Look for signs of hesitation or rejection as price nears the previous day's high or low. Wait for the break and failure. If price breaks the level but quickly reverses, this is your potential entry trigger. It's best to look for confirmation. This could be in the form of a reversal candlestick pattern, a shift in momentum, or increased volume on the reversal. Once you have confirmation, enter in the direction of the failure. For a failed high, you'd go short. For a failed low, you'd go long. This scalping setup works well because it aligns you with the likely intentions of big players. These key levels are often where large institutions place their orders, creating liquidity pools. When price fails to break these levels, it often indicates these big players are defending their positions. Perfect strategy for beginners, as this setup offers a clear mechanical approach to entering trades. In this example, we've marked the previous day's levels. As the new trading day begins, we see price trending downwards towards the previous low. As price approaches it, you start paying close attention. There's a quick spike down, breaking below the previous day's low. However, the next candles immediately reverse, closing back above the previous day low. This is a failed new low. We also notice that the volume on the reversal candles is higher than the previous candles, implying strong buying interest. This is your confirmation. So long trade here, just above the high of the reversal candle. The stop loss goes below the failed low. For your target, you might look at the previous swing high. Sometimes, price will even go to test the previous day's high. In this chart, we've marked the previous day's levels. As the new day starts, we see price pushing upwards towards the previous high. We see a quick spike above it, but the next candle closes back below it. This is our failed new high. This is almost a textbook setup, with a pin bar with a large wick above the previous high. Short trade, just below the low of the pin candle. Stop loss goes above the failed high. One key aspect of this scalping method is understanding the concept of liquidity. Previous day highs and lows are often areas with lots of stop losses and limit orders. Big players in the market may push price into these areas to hunt these orders, creating the failed break we're looking to trade. So with this setup, you're essentially trying to align yourself with the smart money. For more advanced traders, you might consider incorporating additional factors. For example, you could look at the overall market structure. Is the market in a larger uptrend or downtrend? Failed breaks that align with the larger trend might have a higher probability of success. You could also consider the time of day. Failed breaks that happen during major market opens, like London or New York, might be more significant due to the increased volume and participation of institutional traders at these times. The first major pullback after a market structure shift is another great scalping setup that combines price action and smart money concepts. This strategy aims to catch quick moves right after a significant change in market structure. A market structure shift refers to a clear change in the overall trend or direction of the market. This usually happens when price breaks a key level, like a previous high or low. When we see this shift, we know big players are likely changing their stance on the market. And after a shift, we often see a pullback. This is when price moves back towards the level it just broke. Smart money often uses these pullbacks to add to their positions before the next big move. When price breaks a key level, it shows that demand for an upward break or supply for a downward break has overcome the opposite force at that level. But markets rarely move in straight lines. After the break, some traders take profits, causing a temporary shift in the supply-demand balance. This creates the pullback. However, if the structure shift is real and not a false break, the supply-demand imbalance that caused the break still exists. So when price pulls back to the broken level, we often see a reaction as the dominant force. Buyers in an upward break and sellers in a downward break step in again. So this is how to trade this setup. First, look for a clear break of a previous high or low. This is your first clue that smart money might be changing direction. After the break, don't chase the move. Instead, wait patiently for price to come back to the broken level. This is where you'll look to enter. As price approaches the broken level, watch for signs that the dominant force is stepping in again. This could be a strong rejection candle, a shift in momentum, or a volume spike. If you see confirmation, enter in the direction of the break. Your stop loss should go just beyond the broken level. Since this is a scalping strategy, look to take profits quickly. This setup works well because it aligns you with the intentions of big players. You are not trying to catch the exact bottom or top, but rather jumping on board after smart money has shown its hand. This strategy offers a clear mechanical approach to entering trades. You are not trying to predict anything, just reacting to what the market is showing you. In this chart, we notice that the price has been in a downtrend. Then we see a strong bullish candle that breaks above the previous swing high. This is our market structure shift. After this break, price starts to pull back. We watch as it approaches the level of the previous high, which is now likely to act as support. As price gets close to this level, we see a long-tailed pin bar form, showing rejection of lower prices. This is our confirmation. We enter a long trade just above the high of the pin bar. Here we notice that price has been in an uptrend, but we suddenly see a strong bearish candle that breaks below a significant swing low. This is our market structure shift to the downside. Price then starts to rally back towards the broken level. As price approaches our value area, we notice volume starting to increase. This indicates that sellers might be stepping in. We also see an inside bar form just below the broken level. This often indicates hesitation in the market. A short trade can be taken once price breaks below this inside bar. Also, be aware that false breakouts can happen. Sometimes price will break a level, pull back, but then continue in the original direction. This is why waiting for confirmation on the pullback is crucial. For advanced traders, this strategy can be combined with other techniques like volume analysis or order flow to increase its effectiveness. Another scalping setup uses the volume-weighted average price as a key reference point, in combination with engulfing candle. Basically, this strategy combines price action analysis with the volume-weighted line. We'll use this indicator as a trading benchmark that shows the average price a market has traded at, based on both volume and price. The engulfing candle is the second component, a price action pattern where one candle's body completely engulfs the body of the previous candle. It's seen as a strong reversal signal, especially when it occurs around the main line. The perfect signal looks like this. Price approaches the volume-weighted line. An engulfing candle forms at or near this area. Then price bounces off the main line in the direction indicated by the engulfing candle. From a supply and demand perspective, here's what's happening. The VWAP represents the equilibrium price for the day. When price is above VWAP, buyers are in control. When price approaches VWAP, it's entering a zone where supply and demand are roughly balanced. The engulfing candle that forms here represents a sudden shift in this balance. A bullish engulfing candle shows demand dominating supply, while a bearish engulfing candle shows supply overcoming demand. The bounce of VWAP confirms this shift and implies that a new supply-demand balance is likely to persist, at least for a short while. This is how to trade this setup. First, monitor the VWAP on your chart. As price nears the line, start paying close attention. Watch for an engulfing candle to form. This is your key signal. After the engulfing candle forms, look for price to move away from VWAP in the direction indicated by the engulfing candle. Once you have confirmation of the bounce, you simply enter in the direction of the engulfing candle. Place your stop just beyond the opposite side of the engulfing candle. You might set your first target at the next significant level. This scalping method works well because it combines multiple high probability factors. VWAP is a key level watched by many traders, especially institutions. Engulfing candles are strong reversal signals. The bounce confirms the reversal and shows that the new trend has some momentum. One key aspect of this strategy is understanding the significance of VWAP. Institutional traders often use VWAP as a benchmark for their trades. If they're buying, they want to buy below the line. If they're selling, they want to sell above it. This is why VWAP often acts as a dynamic support and resistance level. In this example, we see price approach the line from below. This suggests that sellers have been in control, but price is now entering the equilibrium zone. As price touches the main line, we see a large bearish candle form. This candle completely engulfs the body of the previous candle. This is our signal. The next candle continues to move downward. This confirms the bounce. We enter a short trade at the low of the signal candle. Stop loss goes just below the high of the engulfing candle. For the first target, you might look at the previous swing lows. Another signal. Again, we have our VWAP clearly visible. We see price approach the line from above. This implies that buyers have been in control, but price is now entering the equilibrium zone. As price touches the line, we see a large bullish candle form. The candle completely engulfs the body of the previous one. The next candle continues to move upward. This confirms our bounce. We enter a buy trade as the high of the engulfing candle is taken out. Very important, market conditions can affect the effectiveness of your scalping results. In very choppy markets, price might cross VWAP frequently, making it less reliable as a support or resistance level. You don't want to see the line being tested in recent candles. For more advanced traders, you might consider incorporating additional factors. For example, volume analysis. Engulfing candles that form on higher volume might be more significant. Market structure also matters. Is this VWAP bounce happening at a significant swing high or low? Also, VWAP tends to be more significant during the middle of the trading session. Early in the day, it's still establishing itself. And late in the day, other factors might become more important. Another factor to consider is the distance of price from VWAP. The further price moves from the line, the more likely it is to eventually return to it. This can help you anticipate potential setups. Also, please note that this scalping setup doesn't always require an exact bounce of the line. Sometimes, price might hover around the line and won't touch it before the engulfing candle forms. Next scalping setup involves a fair value gap fill after a breakout. This strategy takes advantage of market inefficiencies and price action dynamics. Fair value gaps are created within a 3-candle sequence. They are typically seen on charts as a large candle whose neighboring candles' upper and lower wicks don't fully overlap the large candle. Here's how it works. Price breaks out of a significant level, support or resistance. During this breakout, a fair value gap forms due to the rapid price movement. After the breakout, price often retraces to fill the gap. This retracement provides a potential entry point for a trade in the direction of the original breakout. From a supply and demand perspective, here's what's happening. The breakout represents a significant shift in the balance of supply and demand. The fair value gap forms because the price movement is so swift that normal price discovery doesn't occur in that area. This creates an inefficiency in the market that often gets filled later. When price returns to fill the gap, it's testing the new supply-demand balance established by the breakout. This retest often provides a high probability entry in the breakout direction. This is how to trade this setup. First, you identify important levels on your chart. These are potential breakout points. Then watch for breakouts. When price breaks a key level with strong momentum, pay attention. This is the first part of our setup. Next, identify the gap. Look for the 3-candle pattern during the breakout move. After the breakout and gap formation, price will often retrace to fill the gap. As price approaches the fair value gap, get ready for a potential trade entry. Look for signs that price is likely to continue in the breakout direction after filling the gap. This could be a reversal candlestick pattern or a bounce off the broken level. Once you have confirmation, enter in the direction of the original breakout. This strategy offers a clear, systematic approach. Breakouts often lead to strong trending moves. Gaps tend to get filled due to the market's nature to seek fair value, and retests of broken levels often provide good entry points. In this example, we've identified a key resistance level that price has been respecting for the past few days. We see a break above it with a strong candle. This 3-candle sequence has created our fair value gap. After this sequence, we see price start to retrace, pulling back towards the gap, giving us our potential entry opportunity. As price enters the gap area, we see a bullish pin bar form. This is the confirmation signal. A long trade is the play here, just above the pin bar's high. The stop loss is placed just below the original breakout level. Here's a sell setup. We've identified a key support level that price has been bouncing off for the past few hours. We see price approach this level and then break below it with a strong candle. This 3-candle sequence has created our fair value gap. As price retraces to fill the gap, we have our potential entry opportunity, a bearish engulfing candle. This is our confirmation signal. The key aspect of this scalping setup is understanding the concept of market inefficiencies. Fair value gaps are areas where normal price discovery didn't occur, creating a sort of vacuum in the market. Prices often return to these areas to fill this vacuum, which is what creates our trading opportunity. For more advanced traders, you might consider adding additional factors. One of them is market structure. A breakout that changes the market structure from bearish to bullish, or vice versa, might be more significant. Time of day also matters. Gaps that form during major market opens, like London or New York, might be more significant due to the increased volume. Another factor to consider, the size of the gap. Larger gaps might be more significant and have a higher probability of being filled. Another powerful method combines market structure analysis with Fibonacci retracements. This approach aims to catch quick moves by entering trades at key Fibonacci levels after a significant break of structure. A break of structure occurs when price breaks above a previous high in an uptrend or below a previous low in a downtrend. It signals a shift in market dynamics and often precedes a strong move in the new direction. Once you found a major break of structure, you add the Fibonacci retracement on it. This tool is used to identify hidden support and resistance levels. We are interested in the golden zone, the area between the 61 and 78% levels. When a break of structure occurs, it shows that either supply in a downtrend or demand in an uptrend has been overwhelmed. The subsequent pullback to the Fibonacci golden zone is a period where the market is seeking a new equilibrium. You are betting that the original imbalance will reassert itself at these key Fibonacci levels. This is how to trade this setup. First, you identify the break of structure. Watch for price to break above a significant previous high for an uptrend or below a significant previous low for a downtrend. Once you've identified the break, mark the swing that includes the break of structure from the low to the high in an uptrend or from the high to the low in a downtrend. Then simply draw the Fibonacci retracement. After the break of structure, price will often pull back. In the golden zone, look for signs that price is ready to resume the trend. This could be candlestick patterns, a volume shift, or simply price action showing rejection from the zone. Once you have your confirmation, enter the trade in the direction of the original break. Place your stop just beyond the opposite side of the golden zone. As for take profits, you might set your target at the next key levels in the market structure. This scalping method works well because it combines multiple high probability factors. The break of structure shows a clear shift in market dynamics. Fibonacci levels are widely watched by traders and often act as support and resistance. And the golden zone is considered a high probability reversal area. This strategy offers a structured approach to entering trades. You are looking for a clear break of structure, then waiting for a pullback to a specific zone before entering. In this chart, we see price break above a significant previous high, signaling a break of structure to the upside. We mark the swing from the recent low to the high of the break of structure candle. We then draw our Fibonacci retracement on this swing. Then price pulls back and we see it enter the golden zone. Now we start looking for entry signals. Here we see a strong bullish engulfing candle. This is our entry signal. Now we see price breaks below a significant previous low, signaling a break of structure to the downside. We mark the swing from the recent high to the low of the break of structure candle. We then draw our Fibonacci retracement on this swing. Price pulls back and we see it enter the golden zone. So we start looking for entry signals. This time a candle with a long wick is rejecting the zone. The length of the break of structure can affect the effectiveness of this strategy. You want to see price breaking a previous swing with conviction. In very choppy markets, false breakouts are more common, which can lead to failed setups. So keep in mind this aspect before taking any trade. For more advanced traders, you might consider add a momentum indicator to find divergences at the value area. If the golden zone aligns with other key levels, it can also increase the probability of a reversal. Now, if you want to learn other scalping and day trading tactics, you need to watch one of these videos next.